Hi, everybody, and welcome back to video number 4 in chapter 6. And when we left off, we were looking at how Rihanna.com will use the allowance method for estimating bad debts. And here we have an aging schedule. So we know it's a receivables method. So we know we're going to need to consider the existing balance in the allowance for doubtful accounts. So here is we need to calculate what we want it to be in this, first calculation by going through the um, aging schedule. Then we need to anticipate the fact that we've got a debit balance in the allowance for doubtful accounts and adjust our journal entry accordingly. And then on C here, Charlie, of the above accounts, 5,000 is a real live write-off. So we need to do a journal entry to write that off. And then the company subsequently collects that it was determined. So we need to restore that account and record the cash collection. And lastly, what would change if Rihanna.com used 3% of total accounts receivable rather than an aging receivable? What are the advantages to the company of aging the accounts receivable rather than just a flat percentage to total accounts receivable? Well, here's what we would do. We would first go through and we would calculate what that amount should be for our estimate. And here it's $10,120 by adding these across based on these percentages. And so now, however, we had a debit balance. So in our journal entry, we need to add that $4,000 to the 10,120, and that gives us 14,120. We'll debit bad debts expense, credit the allowance for doubtful accounts. Now, we have a real live write-off. So in this case, we're going to debit the allowance, which has this credit balance now of 14,120. And now we're going to debit that and credit the specific account receivable that was written off. But now that proves to be a bad judgment and that a customer makes good. So we'll put the receivable back up, just simply the reversal of the answer in Charlie here. So in Delta here, we're going to reverse that, and then we'll collect it like normal with a debit to cash and a credit to accounts receivable. Now, if they just used a flat percentage of 3%, that's going to come out 3% of $377,000 here. If I do that, I'm going to get, I think it's 11,310. And so 11,310 plus the 4,000 debit balance that's already existing, we're going to add those two together to get 15,310. And so aging the individual accounts rather than applying that percentage, a flat percentage to total accounts receivable, would, as I've mentioned, provide a more accurate estimate of allowance for doubtful accounts and bad debts expense. Okay, here we're going to try to explain the accounting issues related to recognition and valuation of notes receivable, remembering that notes receivable are a formal written promise, formal promissory note. The written promise to pay a certain sum of money at a specific future date. This is not a handshake agreement. It has different legal standings as a result. It's a negotiable instrument, and the maker signs in favor of a payee, right? The maker is the person that owes, be the customer in this case, usually on a note receivable. So it's usually interest bearing, and it usually has a stated rate of interest. Zero bearing interest, that's interest included in the face amount. So let's take a look. Customers, generally, we're going to generate a note receivable to customers who need to extend the payment period of an outstanding receivable. Sometimes, instead of giving them accounts receivable right away or putting them on cash and carry kind of basis, we might set them up with a note receivable for maybe a high risk customer or a new customer that we don't have sufficient financial information on to help us make a decision as to whether to grant them terms, meaning going into an accounts receivable situation. So sometimes we have loans to employees. I've done that several times, and to our subsidiaries. Sales of property, plant, and equipment almost always will require a note, and then lending transactions almost always will require a note to a bank. I've never done one, shall we say, to a bank that didn't require paperwork of the Cluzoo. In any event, the time diagram for a note is issued at face value. You see it here presented graphically. We have $10,000. The Fjords in Unlimited lends Scandinavian Imports $10,000 in exchange for a $10,000 3-year note bearing interest at 10% annually. The market rate is this for a similar risk is also 10%, just to keep it simple. Okay, so here's our present value table, table 6.4 in the book, and you can see that pretty easily here. And now we'll take a look at 10% for 3 periods is going to be a factor of 2.48685. So now we take that $1,000, multiply it by 2.48685, we get $2,487, which is its present value of the interest that we receive over 3 years. Okay, now the present value of the principal, we're going to look at the 10% column for 3 periods, and we get 0.75132. And that's going to be the present value, table 6.2. And now what we're going to do is we're going to take the principal, which is $10,000, multiply that times 0.75132, and the present value is going to be $7,513 of the principal. Okay, interestingly enough, by the way, if I take that 2,487 and add it to 7,513, I think you're going to find that comes out $10,000. Okay, in fact, that's just exactly what this shows. Here's the face value of the note, the present value of the principal, the present value of the interest, the 3 payments, and we're going to subtract that. There's no difference in this case. So we record the receipt of the note by generating note receivable for $10,000. We received cash for $10,000. Now, to record the interest earned each period, I'm going to debit cash for $1,000 because I'm earning that interest every year, and we will call that interest revenue on the income statement for $1,000. Okay. Now, sometimes we have 0 interest-bearing notes. So that one takes a little finagling because the company receives a 3-year, $10,000 0 interest-bearing note and gives cash of $7,721.80 to the issuer of the note, and the issuer of the note is the borrower. At the end of 3 years, Jeremiah is going to receive $10,000 from the issuer. Because Jeremiah knows both the future value and the present value of the note, Jeremiah can therefore compute the interest rate. This rate is referred to as the implicit interest rate. So here is going to be $7,721.80 divided by 10,000 here. And that's going to give us a factor. So now we're going to go look that up on the present value tables. And here it is. And we can go find that on the 9% 3-period table. And so that means our interest rate is the implicit interest rate is 9%. And they're using table 6.2 for that. And there she is. All right. The difference between the future value and the present value of $2,278.20 is called a discount, and it represents the implied or effective interest on the note. Jeremiah is going to record that as follows. We're going to debit notes receivable for $10,000, but we're only paying $7,721.80 in cash. The difference is a discount on notes receivable of $2,278.20. Okay. Now, here we're going to amortize that using the effective interest method. So you'll remember that our effective interest rate was 9%. So in this case, our carrying value was $77.2180. We'll multiply that times 9%, and we get $694.96. The difference is going to be the amount that we amortize here. And so that sets up a new carrying amount, which is ratcheting up to $10,000 eventually. And so now we take this carrying amount and we multiply that times 9%, et cetera, et cetera, et cetera, until we're effectively amortize that discount from $77.2180 to $10,000. All right, so what are the journal entries to record that? Here, the discount on notes receivable and interest revenue for the 3 periods, the accounts are all going to be the same. The numbers are going to be different based on that schedule here. As you see, the discount amortized schedule. Okay, so Jeremiah is going to prepare an entry debiting cash and crediting notes receivable when the issuer pays the note at maturity at the end of year 3. That's pretty obvious. Okay, so a time diagram here for interest-bearing note. It makes a loan to Marie Company, receives exchange at 3-year $10,000 note bearing interest at 10% annually. In this case, the market rate of interest is 12% for a similar interest. So we have a little manipulation we got to do with that one too. So here we take the 12% 3-year column. We get that. We multiply that through just like we did before to get our present value of the interest. We do the same thing here for the principal. We take the 12%. Notice that's at the market rate, not what's written on the note. And we calculate the present value. And that then is going to dictate the fact that we have a discount here of $480. And so then our receipt of the note is going to be as follows. Okay, that looks like a good place for us to end this video. And when we return, we'll take a look at how we do that effective interest.